Welcome back, everyone. I'm Bennett Tomlin, and right now I am not joined by my partner in crime, Piancey, though he should be joining us shortly for this episode. He is down in Reno right now investigating a blockchain city. But we are joined with a very special guest today, Director of Quantitative Research at Moody's Analytics, Lily Francus. How are you, Lily?
Hey Bennett, nice to be on. Finally, I know we've talked about this for a couple months now, and I'm glad the schedules could work out.
We're very excited to have you on. So, one of the pieces of work that you've produced that I found especially interesting was, along with several other cryptocurrency researchers, you produced a piece that began to create a framework for understanding lending risk in DeFi. Can you share what that framework sort of looks like?
Yeah, so this was a piece that actually I wrote, under the context of Moody's. A lot of people actually know me from just my Twitter and, my work on options and other sources of, understanding market structure. But this was something that we released actually in January with Moody's and the Gauntlet team. So Gauntlet is this, crypto company run by Tara and Chitra, a friend of mine as well, that essentially they work with these protocols to manage their risk and optimize for collateralization ratios of various tokens they accept or other crypto assets. So from this angle, we kind of looked at it from traditional corporate credit risk because, at its face, a lot of these DeFi lending protocols, yes, it's a new paradigm maybe, but essentially it does follow the same laws as traditional banking understanding. And if you look at banking, you don't have to look much farther than Basel III regulations as making sure that certain types of basically collateral are accepted as well as reserve ratios. So while there's definitely some differences in crypto, and I think a lot of it has to do with the volatility as well as difficulty of moving money into the crypto and out of the crypto ecosystem, essentially the principles are similar. So, when we looked at creating this framework, or at least, this rough draft of a framework and hopefully soon to be an actual framework, essentially we kind of started from the ground floor here where, we looked at what is the basic interaction of a lending protocol in DeFi. There's a lot of DeFi protocols that aren't, direct lending. You could argue that any kind of pooling structure is a pseudo lender at the very least. My favorite and kind of the case example here was MakerDAO because it does conform out of any kind of crypto DeFi protocol the closest to our traditional understanding of what a lender is. That said, it's very interesting because, one of the unique aspects of crypto is this idea that code is law. So fundamentally, a protocol, once it has been published onto the mainnet, essentially cannot be changed other than in the constraints of what is allowed in its code. There are ways that a lot of these protocols can conduct governance, and that is part of their actual smart contracts that encode it, which allow them some sort of flexibility as the macro environment changes, usually negatively. That said, you don't have the risk like you do in traditional lending, where let's say I'm an investor, I give a company my money. A company at its core is a black box, so realistically, you will never know the internal day-to-day management of the company. Of course, as an investor, especially a large one, you do have specific insight from meeting with the managerial team as well as reviewing their publications, let's say by the SEC. But, you do not get that kind of transparency that you do see on the blockchain. At its core, a protocol cannot go away and abscond with your money. Theoretically, if it's in the code, and this is kind of basically a critical point when we think about what credit risk looks like in crypto, is basically that the code has to operate the way that it was intended. Whether or not you understand the code when you put your money into, that is where the risk is. So we've seen a lot of famous hacks recently, Ronin Bridge, for example, Beanstalk Finance. These arguably are not hacks in what we'd consider the traditional sense. In both cases, they were kind of social engineering. I would probably lean more to calling them hacks, but we did have some debate on Twitter. But I guess the TLDR here is that our understanding of credit risk on the blockchain has been transformed from depending on the creditworthiness of individuals, or, in more formal legal terms, you could say on the company or the obligor itself, to worrying about code quality and the ability that it could lead to something unintended by both either the author, if you know who they are, or at least the person lending the money. So, we kind of looked at this framework, in the traditional DeFi framework right now, you mostly sit on these over collateralized models, because fundamentally what I always say is that credit is the delta between your collateral and your loan value. So, when you think of stuff like loan to value ratios, if we were to think about it in a normal world where I was like, Bennett, I'm going to give you $100, but you need to give me $100 as collateral. In that case, your LTV is 1, but that's because you, or I guess I'm the lender here, basically I have full faith that I can take the $100 you just gave me and turn it into $100. So my risk effectively is 0. But in the crypto landscape, that's completely different, because so there's 2 issues. One, not only is liquidity a lot lower than even traditional financial analogs. Even the most liquid markets, which are like maybe CME Bitcoin futures, or, maybe sometimes Binance, it's just the level of liquidity is not there. We're talking about billions of dollars will have a measurable market impact, while, good luck trying to make a measurable market impact on a normal day on the S&P. I mean, it's getting worse, and I do believe you've talked to Mike Green. So, I think that's one of his favorite points, that basically liquidity has diminished, at least visible liquidity, even in the traditional equity markets. But in crypto, it's much worse. The second part is liquidity is fragmented. So because of the fragmentation across exchanges, yes, there is arbitrage that's going on, which does keep it line to line, but essentially moving size in crypto, especially at short notice, is much more difficult. And that's why most DeFi protocols as is do depend on over collateralization to kind of hedge out their volatility risk and market impact risk. Does it work perfectly? No. Do they err on the side of caution? Yes. Is it capital efficient? Absolutely not. But looking at this, we kind of determined that the TLDR is there's no real mechanism of credit risk yet in DeFi, due to the fact that everything is over collateralized. The most salient risk on the short term is, of course, smart contract risk or Oracle risk. Oracle is being, and I'm sure your listeners already know this, but Oracle is being the source of truth APIs that essentially connect with the blockchain and allow the smart contract to operate based on real world events. There's governance risk, which I think is long-term probably the most impactful, in which case, how is the token governed properly? We've seen pretty famously this year with Sushi as kind of a laggard and a pretty good case study, and that governance eventually does have an impact even in crypto. There's clearly currency valuation risk, which I've also written about in the risk-free rates, and what that means under cover interest rate parity. And there's probably the most salient is regulatory risk. This ecosystem, a lot of promise. I work pretty closely with individuals who are close to regulators, but a lot of these major institutional players will not touch crypto with a 10-foot pole right now. Until there is sufficient clarity from regulators. Not only is it an issue for long-term investment, but even for certain concepts like real-world assets or privacy coins or stable coins are all still fairly up in the air. I will give credit to the Biden administration that they've been making an attempt here, at least better than the European Central Bank. But, it's still a risk factor. And, I'm looking forward to doing a lot more work on this, but it's an exciting, dangerous area, basically.
That was a fantastic summary. And I do have follow-on questions. One of the reasons you suggested that the lending had to be over-collateralized is because the liquidity is so fragmented and is so much less than in traditional finance. Whereas when I think of decentralized finance lending, it seems challenging for me to figure out how, outside of the potential liquidity issues, how to reasonably measure and extend loans based on trust. Do you think that under-collateralized loans are something we are ever going to see at a meaningful scale in the DeFi economy?
So I think it's fundamentally a question of, do you believe DeFi is a new paradigm that will take a significant amount of traditional financial transactions? My optimist answer is yes. I do think there are interesting, especially cross-border implications of DeFi. And I think that fundamentally it is a fairly efficient way to gather capital. There have been lenders that have bridged this idea of under-collateralized or non-collateralized loans, like Goldfinch Finance, which essentially operates as private debt market, where you see that the actual lenders get their inflows via DeFi, but they work with traditional KYC providers, TradFi, basically in the local regions to kind of give out the loans. So there's two major issues here. Over collateralization in the ratio fundamentally depends on the question of, when the market goes to shit, can I liquidate it and not incur a loss? Reasonably speaking, most protocols will operate some sort of reinsurance scheme where they will try to collect a reserve so that in turbulent times they can buttress against loss of collateral value. I mean, you saw this pretty evidently in March of 2020 where, MakerDAO had a massive cascade during the massive sell-off of crypto, like a 50% down in a couple days. And, a lot of their collateral was liquidated for literally zero. So the issue, of course, is this reinsurance scheme largely at the current time depends on governance tokens themselves. And, this is not too dissimilar from the idea of equity as a call option in traditional finance or the Meriton structural model of credit risk. But at the same time, it's basically an IOU scheme on the protocol's future operation. So it's a metastable equilibrium that would work for very short-term pain, but fundamentally this equity, because for instance, Maker has a burn scheme that in good times that protocol surplus is used to conduct open market operations, buy MKR, and send it to a burn address. In bad times, the protocol then uses that same operational scheme as a way to mint extra MKR so that they can cover protocol deficits. The issue, of course, is that depends on a marginal buyer stepping in. MKR, just like any kind of equity or pseudo equity, you will observe that it's very sensitive to market factor performance. I mean, crypto beta is something I've talked about on Twitter pretty heavily, but realistically speaking, you see these incidences. I think a famous one was called Iron Finance, where you have, and this is kind of, we can talk about stablecoins too in that vein, but you have this scheme of, A and B token, where A is a pseudo equity that acts as a volatility absorber. And this is what you see even with the DeFi governance schemes, basically. And it works for short-term acute pain, I think, very well when you expect the market will bounce back. But fundamentally, it's just not the same as a true reinsurance pool.
You mentioned the MakerDAO Black Thursday event back in March of 2020, and one of the complicating or extenuating factors in those liquidations was, of course, that the keeper contracts were not configured to adapt well to a congested chain in this high-fee environment. So would that type of risk, like the entities intended to bid up and collect this collateral, do these liquidations, is that like a part of smart contract risk when they're configured like that, or how does that fit into the risk model?
So we talk about it as one of the main factors is called cooperative risk. And you do see this with DeFi that certain, or pretty much every protocol I know of, depends on the action of arbitrageurs or at least some third-party liquidators to essentially call certain functions or certain actions that the protocol needs for financial incentive. And the issue, of course, is that depends on a stable system. In the Black Thursday event, clearly the incentives and ability for arbitrageurs and liquidators to operate was severely impaired. That said, this is part of proper modeling, and I believe part of what Gauntlet does. Essentially, you need to make sure that not only are you properly incentivizing that these activities occur in a sustainable way, but also that you minimize their importance or at least factor that into your calculation of risk. I mean, realistically, there's no perfect system here. I think that there's a lot of work basically that's going to be determined over the next year, especially as we slide into a more bear or muted market, on understanding crypto risk better. I do think that, my keyword that I flagged in cooperative versus sustainable, because a lot of these protocols operate these essentially equity dilution schemes. That would be the closest to an analog in traditional finance, where they have some kind of arguably worthless governance token that may eventually collect dividends from the protocol's operation, and they use it as a means to incentivize either liquidity providers or arbitrageurs or something like that. And the issue, of course, is in the beginning, because there's a speculative boom, it's very similar to what I've talked about with Tesla and the idea of at the money equity offerings, this idea of value ex nihilo. Speculative value can turn into value in certain cases, because fundamentally it creates a pool of capital which the management team can draw upon to actually build or acquire or generate some kind of sustainable business model. But by itself, it is not a sustainable business model, clearly, because, I think The Simpsons did it best a couple of years ago. You can print as much monopoly money as you want, but you don't change the actual value of the money that's backing it. And I've actually written a post about this recently, about crypto as this hot bowl of money, where essentially you have a lot of these protocols that they depend critically on their operation on incentivizing based on arguably more and more worthless, governance tokens. So the issue is it becomes extreme negative convexity, because as the value of the token goes down, the incentive goes down, which makes the protocol operate worse, which makes the protocol's token go down more. And that is kind of the death knell. And I think a lot of insanely intelligent people are working on bettering the economics here. But fundamentally, this is what you're going to see in a true bear market with a lot of these protocols, because if your protocol's sustainability only makes sense when the token price is either stable or going up while you have this continuous dilution model, then you're probably not going to be around in 2 years.
Yeah, and that's an incredibly common model. I mean, most tokens that are talking about staking are often doing basically, you're capturing your proportional share of the inflation and not getting diluted out. I remember when I looked at Olympus DAO, that's what the entire thing was. They're minting more and more of the governance token, and if you stake, you make sure you control your portion of the market cap, which is one of the things you talked about in your series of articles on risk-free rates and conceiving of a cryptocurrency risk-free rate. And the reason I chuckled when you were talking there is because one of the quotes I had pulled up in my notes from your articles was, the way I personally view the current ecosystem in cryptocurrency is akin to a hot giant pool of money. And so I had also pulled that one out. Could you help introduce our listeners to the work you've done in laying out this path towards a cryptocurrency risk-free rate?
So, yeah, I mean, again, I approach this from very much a quantitative risk modeling perspective. This is kind of similar to what we do at Moody's Analytics with traditional finance. And kind of the cornerstones of quantitative risk modeling are, you need to be able to calculate a theoretical price of risk in the market. Theoretically, at least if you follow modern portfolio theory, every type of return over the risk-free rate is fundamentally an efficient market, and there's a couple other assumptions here, so please don't chew me out in the comments. It's essentially that you're taking on excess risk. So there is, Markowitz, I believe, was one who did the efficient frontier model, where basically, there is an optimal way to construct a portfolio for a given level of assumed risk and return. And what that means is that if we are thinking about either relative or even absolute risk in crypto terms, we can essentially assume two things. Right now, there's minimal economic value inside the crypto ecosystem. So basically endogenous value creation. There are some exceptions that I'm not going to mention, basically, where I do think these may be true economic value here. That will by itself be controversial, but if you look at economic versus speculative value, I think most people would argue, yes, this is probably a fair point. So what is interesting about that is we could then extend that argument and say that any excess returns in crypto over the crypto risk-free rate, and we could say this on a blockchain level, for example, are due not to economic value creation, but to increased risk being taken. Again, this is going to change over time. I do not believe every single source of yield in crypto is just due to risk, but we can clearly see that a lot of them are. I mean, you also see some things that are just completely unsustainable yields, which I won't name here as well, but we all know which stablecoin protocol I'm talking about. Basically, that's not necessarily being paid for risk. That's because someone is essentially just subsidizing it. But it's clearly not sustainable. And, even that team, they are very well aware that the long-term rate will be a lot lower than it is right now. But given that, you can't really start talking about quantitative risk in crypto without at least getting an idea of what the risk-free rate is. I think that, the first, actually for people is that if you follow traditional financial theory, there is only one risk-free rate in the world. If you have a completely open economy, closed economy where there are no capital controls, logically speaking, this is a pretty simple proof by contradiction, there should be only one risk-free rate. What you see in practice, of course, is that there's very severe capital controls between crypto and, TradFi. It is very much non-trivial to get $1 into crypto. And even if you're in crypto, and I've talked to friends at very large prop trading firms, it's even more difficult to get it into DeFi itself versus, let's say, laboring on a centralized exchange. Because the regulations are not there. The idea of custody is really difficult. So we would expect that there would be an endogenous risk-free rate for $1 that is present in DeFi that would probably be higher or, at least different than $1 outside of DeFi, $1 in the real world, for example. You could argue that the difference in those risk-free rates represents the difficulty and assumed risk of just being in DeFi, because fundamentally there is a background risk if you're in DeFi at all. There's also a risk if you're on a centralized exchange, which I've talked about significantly, but these are all in the context of themselves. So $1 that's already in DeFi, the risk-free rate is the rate of return you can expect without assuming any extra risk. So we all have, risk. Every single asset in the world has risk. When we talk about the risk-free rate in traditional finance, we largely assume US treasuries, and that's because we assume it's in US dollars. But the thing is that for someone who, let's say someone who owns Japanese yen, a treasury is clearly not risk-free because of the exchange rate risk. Someone holding a US dollar more or less arguably holds no extra risk holding a treasury than holding the dollar itself. But that's only in the context of being in the dollar space that we consider the treasury to be a risk-free rate. So there, you could use this line of logic to basically assume that each blockchain should also have its own endogenous risk-free rate, where if I own an Avalanche token of Ox, then basically the risk-free rate would be some operation that I could do with my Avox token that would not increase my risk over the risk I already have owning Avox. And because of that, staking is pretty much the natural analog here. I think historically, people have viewed the futures basis trade on exchanges as the risk-free rate, but that has, even papers have been written, it runs fundamentally into problems because it relies not only on the implied exchange risk premium, so what the market views as the risk of holding $1 on the crypto exchange, but it also has supply and demand effects. So it's very hard to, basically separate it out. While staking, on the other hand, at least in networks that don't have slashing, for example, you could argue is the closest to a true risk-free rate, at least inside of the currency space itself.
And then even in ecosystems where there are slashing, you expanded your definition for these currency-specific risk-free rates as like the staking yield minus the inflation minus the overall risk of being slashed to still arrive at a risk-free rate for ecosystems with the slashing, if I'm understanding that correctly.
Yeah, so I've had some interesting talks with some folks that I won't name them because I think they're writing a paper who essentially argue against my proposal that, or it's hard to say against, but they argue that the true risk-free rate in DeFi is either 0 or negative. I need to philosophize on that a bit more. I think there's arguments that are problematic there because, essentially in an asset space itself, a negative risk-free rate, the implication is that it's essentially a bubble. So, if you have a negative risk-free rate in the context of operating an atom, or let's say I give you an investment that the risk-free rate is going to reduce your atom over time, the Cosmos token, then essentially, so there's two ways you could view this. One is that if the risk-free rate is negative here, then overall the market cap, assuming it stays the same, the price of atom should go up relative to other currencies because it's essentially a burn inside the currency itself. The other way to view it is view that actual total risk-free rate is negative. So in the context of I hold atom and invest it, but I'm looking in dollar space, then essentially it just becomes isomorphic to a bubble. So, you would expect that the future long-term value would be zero, and through backwards induction, you can assume that the present value is also zero. So there are issues with that kind of reasoning, and this is kind of goes into the field of rational bubbles in economics. But fundamentally, my guess, and I haven't done, true analysis on this yet, is that even if you use that line of staking yield reasoning, the risk-free rate is probably positive. And it probably, once you account for capital constraints, risk of slashing, exchange rates, if the markets are efficient, you would assume that the risk-free rate in crypto would be very similar to what the risk-free rate outside of crypto would be.
And so, sorry, what I'm trying to work through is that there's a good chance after Ethereum goes through the merge and with EIP 1559 active that Ethereum will be deflationary. And so could you help me understand how the risk-free rate interacts with that inflation term, especially when it goes negative?
I don't know the specifics technically with, Ethereum's merge. I do think that the traditional paradigm we're staking, so right now staking rewards or the risk-free rate at its basic core is a combination of inflation rewards, which is what you mentioned with deflation, as well as transaction costs. So the actual use of the network. You would argue that in most cases, the long term, so if you look to time as infinity, the aggregate value of the inflation reward is zero because so first of all, it's very PvP in the sense that inflation rewards do not actually generate any true economic value. They just shift the balance of who owns the market cap of the currency itself. So if you have an inflation reward-based staking model, fundamentally, any kind of value add is endogenous to those who stake at the expense of those who do not stake. On the transaction model, clearly you could argue that is a sustainable yield and represents the demand for block space. So fundamentally, the deflationary aspect here, I'm not exactly clear what the specifics are in deflation, currency or we could just argue that it's staking without inflation rewards. So in that case, you would see that the risk-free rate would essentially just be the relative transaction volume or relative transaction fees that are paid by the network at any given time, which of course it's a variable rate that's always positive, but it's not, a fixed rate. So then you'll see the evolution, and you're already seeing this with like Alchemia and a couple other, I think Strips Finance is another one, where you're going to see an active futures market, and this kind of very much starts to look like the overnight rate and repo rates in traditional finance because, arguably the treasury rate is, it's the government is basically taking out debt which can be inflated away long term if the government is running a deficit. So you could say that's more analogous that bondholders, in the treasury aspect of US dollars are being paid in inflation rewards, at least when it's running a deficit. Otherwise, you're depending on the actual economic surplus that's gathered by the government. But in the transaction fee model, it's very much more similar to like the overnight rate and repos, where you could start seeing futures contracts being traded on the market's expectations of it, which would probably be a more real, risk-free rate.
Hey, I know I'm coming in halfway here, more than halfway here. Hi, Lily.
Hey, Kaz.
But I did want to maybe you've gone over this already, but I did want to ask you, hearing all of this and hearing you talk about all the risk and hearing about you talk about how this resembles traditional finance in so many ways. I know you're more bullish on cryptocurrency in general than Bennett and I are, And I'm wondering if that's because you see it replicating the traditional finance system and moving closer and closer to what traditional finance does, or if you think there's a lot of value add there that hasn't been actually realized yet.
I think that's a pretty good analogy. I do think I'm actually more bullish and feel more safe, being in the crypto space because there, as I said on Twitter multiple times, there's nothing new under the sun. So, a lot of this stuff, even what I just talked about in traditional finance, the analogy is the FRA OIS spread, basically between the 3-month LIBOR and, the expectation of the overnight index rate, where you see that these analogies, like the variable staking rate accounting for splashing risk, and these futures contracts that can essentially trade on it, which would be very much similar to a 3-month LIBOR rate you'd get in the traditional, not LIBOR anymore, but when LIBOR was still around, that basically you see them in traditional markets. So I do think that, there's two ways to look at it. One, you could say is, look, well, it's replicating traditional finance, so it's maturing as a market, and there's unique parts of crypto which are strictly better than we have in traditional finance. I think that, like I said, international settlement is a big one. I mean, if you know financial history, there was a famous case with Hirschstadt Bank and FX settlement, and might need to look up the specifics because it's been a while. But essentially, two banks had an order to settle, and the counterparty went out of business. Literally, this was the 26th of June in 1974. Hirschstadt's license was withdrawn by German regulators at the end of the banking day. And some other banks worldwide had undertaken foreign exchange transaction with Hirschstadt and already paid Deutsche Mark to the bank during that day, believing they'd receive US dollars from Hirschstadt's own account. But because of the time of settlement, by the time they were, expected to get the money back, that bank didn't exist anymore. So you basically, in crypto, that's clearly not an issue. Although you could argue that the downside of that is, first of all, basically self-custody is a big problem, especially for richer people. But second of all, you could argue that you don't need a permissionless blockchain. You could also use a permissioned one. Like, what if we put Swift on the blockchain? And I would say, yeah, basically, so obviously the permissionless is more of a technological curio in that case, rather than something that's uniquely an innovation of crypto versus a permissioned blockchain.
What would be the benefit of putting Swift on the blockchain?
Well, I mean, Swift is a messaging system, so you probably wouldn't want to put Swift. It was more an example. It would be more like, I don't know, we could have like the FedNow, that it's basically a new payment rail that's being added next year by the Fed that will kind of supersede the ACH system of the early 1970s. And what that does is it was going to provide much smoother and much, less costly transactions. So you could say, well, why don't we build FedNow on the blockchain? And the argument is, blockchain is basically like Git, because I'm a software engineer. It isn't by itself necessarily the most efficient system, but it does have nice properties when you aren't sure about the liveness and consistency of records. And for something like the FedNow, it's the US government. So like they rule by fiat. So there's very minimal benefit in those cases, making it a blockchain setup versus a traditional database system. But, going more to the downside of if crypto is replicating, traditional finance, you could also argue that the pessimistic case is, well, so why do we need crypto? And like I said, I'm more of an optimist by nature. I do think that some of the innovations we're seeing and the speed of it is pretty incredible. You could have said the same argument about the internet. It's like, why do we need e-commerce when we could go to the store? Or why do we need email when we have letters? At the end of the day, I'm sure in the next 5 to 10 years, assuming crypto is still around, we're going to see more and more innovations that are very much crypto native, and we're going to wonder how things were done pre-crypto.
So yes, like, why do you need crypto there? And generally, the reason I have to reflectively respond is because you're trying to build these censorship-resistant systems, right? And that's, for me, often what the foundational innovation of cryptocurrency and these systems are, is the ability to do things in a censorship-resistant way. And so that's always been my difficulty with understanding the utility or appeal of permissioned or private blockchains, because when you have an entity or a group of entities who can all agree to set up this thing and do this thing, I struggle to understand what the marginal benefit of adding a blockchain to that situation is.
Well, I think we've seen it. I am basically the granddaughter of two Holocaust survivors. They basically they lived in Romania. My grandmother, her lands were stolen. They had oil lands, so I would be much wealthier. If World War II didn't happen, or my family would. They eventually fled communist Romania to go to Israel, basically back in the 1960s. And, what we saw even under these authoritarian regimes is you couldn't, if they let you leave, you just count your blessings, and you don't leave with anything. You leave at night, you pack your bags, they steal everything you own. So we have to be mindful that, of course, we are the children of Pax Americana, where the world is, by most metrics over the last 50 years, gotten better. But I could see, even from the comfort of my high rise in Oakland, that, there is a place in this world for storing value outside of the purview of a government system. Government is very much like a protocol in the sense that clearly there's more flexibility in how government operates. And we have a system in the US that we can amend. It's difficult, but it does rely on the social consensus and this mooring to social norms that is more fragile than most of us want to admit. I mean, we've seen the rise of populism in the West since, the late 2010s period. We saw recently with basically the Ukraine war, or the Russian invasion of Ukraine. Peace is fragile, and, I think that in normal times, there is minimal benefit to this idea of a completely censorship-resistant monetary system and, execution. If you have a smart contract layer, there's minimal benefit over what we currently have now. In a lot of cases, it's strictly worse. Basically, tax reasons, it's slower, it's more expensive. But, in bad times, when our traditional systems do go against us, and that's kind of the cycle of human history, I could see it. I think that Web3 has a lot to go before it becomes usable to a normal person, before it becomes something that would actually be competitive with most of our applications we know and love on the internet. But yeah, this is not. I don't even own enough crypto to shill it to you guys. It's just realistically,
Sure.
just looking at the era of history, there is room for money that is easily custodied and is not under the purview of the government.
I don't think either of us disagree on that. I think that we've both stated, at least unequivocally, that we think like non-governmental money, like Bitcoin, is a very cool idea. And I think Bennett is more bullish on like smart contracts than even I am. I think we acknowledge those use cases. I think what Bennett was saying before is that introducing blockchains to concepts that don't need them, like I look at the Fed, or the way that the US monetary system works, and when people go, oh, but you could do it on the blockchain, and I go, why would they want to do that? I don't understand why they would want to do that.
Yeah. So just to add on, my point I was trying to make is that the value I do see is in the censorship resistance, is in the times where it is outside of the purview of these centralized entities, where there isn't like a list of people agreeing to coordinate on a single blockchain, and where it is this globally distributed network. The part that I've always struggled with is the private and permissioned blockchains, because it doesn't seem particularly useful technologically to me in those instances.
Well, I think, putting on my software engineer hat, the major benefit of private, because this goes into consensus protocols, and, I think the fundamental basis for permissioned blockchains is really the same as any kind of distributed database system, where you are concerned about liveness, you're concerned about corruption. It's arguable that a permission blockchain really is just a distributed database. So maybe it is an idea of nomenclature, but fundamentally, cryptographic hashing of database records has long preceded the current Web3 stuff. So whether we call it permission blockchains or, geo-distributed databases, I think it's really the same technology.
Recently, you tweeted about how in 5 to 7 years, you would like to run for office. How serious were you being, and how tongue-in-cheek was that comment?
It's interesting. I've always considered it. I think part of it when I was younger is that, I don't consider myself very charismatic or easy to talk with people, which is kind of a death knell, especially in American politics. As I've gotten older, I've realized that I'm not as bad as I thought. I don't know. I don't have any specific aspirations electorally right now. I do want to make the world a better place. I also love to communicate with people. I mean, that's why I kind of blew up on Twitter, was essentially because here's this like mid-20s girl talking about option theory in a way that normal people can kind of understand. So I do think that's missing from American politics, especially where, I even mentioned this today with the GDP figures. You have all of these moderately dishonest takes about current events that can be construed according to whatever narrative people are trying to create. The GDP today came in negative. I understand it was partly due to a trade deficit. You could argue till the cows come home, government spending. But unless you had those same kind of reservations when it was positive, that's just called being disingenuous. And I think that I've gotten more and more cynical, especially about political stuff, as well as somewhat about the media over the past year. And I am a liberal progressive. I voted for first Warren, then Biden. I never honestly voted Republican in my life. So I'm saying this as a Democrat, although that's clearly my political views and not my employer by any means. But it's just disappointing to see that at this point, I think both sides are essentially ignoring the true problems we have. Climate change. If you ever want to be depressed, go read about sustainable finance. I was doing research on COP26 and I'm like, Jesus Christ, I think we're going to die. Because if globally we cannot even commit $10 billion properly a year to sustainable finance across the globe, we've given way more in tax cuts in the US. And this is our planet, guys. Like, I'm not basically saying that we need to, switch from all of our oil tomorrow and destroy the economy, but we have severe income inequality. We have climate change. We have social issues, severe social issues and partisanship. We have basically nihilism growing in people my age and even the Zoomers. And it's like, someone, like, it doesn't need to be me. I just want someone who can basically sit down and be like, yeah, shit's kind of screwed up, guys. I don't have all the answers right now, but at least I want you to know that I will fight for you guys. I'm not here to take cheap political shots. I'm not here to promise you the moon for stuff that we cannot afford and that's not even, economically, socially possible. But I want to explain what's going on and I want to know that you have representation in office. And that's all I want to see.
Well, with a platform like that, you've got my support. Cass?
Well, I mean, I would never ever run for office. I think that's cool that you're considering it, Lily. It's
Is it because you're a felon, Cass?
yeah, it's because I'm a felon.
No, I mean, I was gonna say for me, it's if I do it, it's years away. I'm a 26-year-old. I would like to do some. I mean, look, maybe we have people like Madison Cawthorn and whatever, and Lauren Boebert, who it's like, well, I guess the bar lowered enough that I can actually fit under it at this point. But I still would like to do something before I actually went to office.
Yeah, I mean, I guess where I'm coming from, what I was going to say is that right now I'm in Reno, and I've been having an opportunity to chat with actually like a lot of politicians, and like it's a thankless job, it's a hard job. I'm glad that someone like you would want to do it, but it seems like it's easy to go into it thinking like, well, everyone else does a really bad job. I'm sure I could do better. But I've yet to see that properly play out, like even on a local political level. I look at the mayor of Los Angeles, or I look at any number of local politicians and stuff, and particularly from a financial perspective, I think being so entrenched in finance, you can look at the stuff and the issues and the consistent and constant wastes of money and go, oh my God, there's a million different things, better things that you could be doing with this. But I wonder, like, there must be a reason that nobody is changing the system.
Yeah, I mean, fundamentally, it goes back to my point about look, it's about trying hard. It's about effectively communicating to the public. It's about basically making others understand that you are there to help and awareness of the current issues that isn't just distorted sound bites. If you asked me when I was, I don't know, 10 years old, I would have told you, oh, I could terraform Mars, I could build a time machine. It's like, I think as you grow up, what you focus on narrows and you get more worldly and in a lot of ways more cynical. But if I was actually to go into politics, I wouldn't go from the idea that I'm going to change the entire system. It's more, I just want to make the world a little bit less crap. Like, that's literally it. And it's not to say that I'm, personally uniquely qualified. I might be less qualified than other people. And in which case I would love to support them. But it's really just, we need a group of politicians. And I'm not saying that all politicians are like this, but we just need people who seem to care and who want to communicate and inform the public versus partisanship, versus cheap, basically, interpretations, versus worrying about your own next run in office. That's literally it. And it's like, I think maybe this is my own naivete, but I think a lot of people would just resonate with that at this point.
Do you find yourself like kind of as an outsider with the liberal perspectives that you have and the idea? And I think Bennett and I are probably on the same page in that I do believe in government. So there's certainly a lot of people in cryptocurrency that seem to fully not believe in it at all. And I'm wondering if, we're talking about self-custody, we're talking about decentralized finance, we're talking about people, largely being responsible for their own financials. But then simultaneously, we're here talking about, a desire to make government better and to be able to help people through governance. Doesn't that feel a bit contradictory almost?
Does it? I'll give you an analogy. In the free markets, we believe competition is good, fundamentally. I mean, that is one of, there's obviously, in terms of the consumer, you have consumer protections, which is fiat. It's by the government itself that essentially regulates businesses. But at its core, we do believe in the necessity for competition in order to provide more pricing power to the buyer rather than the seller, especially for critical services. In some cases, we permit natural oligopolies or natural monopolies. But in general, we do view competition as a good thing, at least in economics and finance. So would it be so bad to have these systems that do act as competition to the government, or would it potentially give the government more urgency to act in the better interest of people? And I don't have an answer to that, but I do think that it is something worth considering.
I don't have any more questions. Do you got any remaining, Cass?
I guess I would just like to know, Lily, I assume you like not only work with people directly all the time who are involved in cryptocurrency, but I mean, you trade it, you like it, you enjoy it. Do you try to bring people into the system? Do you try to get people to understand it the way you see it as well? Or do you think that there's a lot of speculation and garbage? And are you more prone to like warn people about the issues or try to lead them into DeFi and stuff, or both?
I think it's essentially both in the sense that, and I'll give you an example. I sold it to other people I've talked to. I think warning about the risks and informing people is part of trying to make this a real thing. I think fundamentally what you observe is that if you have no risk and no leashes, eventually it's all going to crash down. People are going to get hurt. That's how it gets destroyed. That's how you see the end of DeFi. And if DeFi and crypto has a future, then people need to be informed. People need to trust it. People need to want to interact with it. And right now, with the current state, I probably on Twitter, I probably have equal lists that say crypto critic or crypto hater or something as crypto like enjoyer. Like, I talk about it from a systematic basis. I do think I'm crypto optimistic, let's put it that way, where I think that if you care about the space and if you do see it as something other than just a quick cash grab, then it is your job to build these systems and risk monitoring that will make sure that people can use it and that the era of, these wildcat banks and super DeFi heists comes to an end.
And sorry, just quick follow-up, but you expect to see that sometime in the next few years, I would assume then, that this kind of like Ronin network hack followed by like, a month after Wormhole or whatever, like where you're having $100 million hacks every month or every week. You think that is a right now thing and hopefully is going to be coming to an end soon.
I do hope. I mean, the thing is, it's kind of part and parcel with the idea that we expect further adoption, because I think that if you do not build these risk monitoring systems, you will not see further adoption. You may see further retail adoption, but at the end of the day, someone is going to measure risk, someone is going to act on risk, and I think most people would agree that they would like to see the industry self-regulate before the regulators do it for them.
Yeah, self-regulation has been a concept for a pretty long time in crypto, and I have really yet to see it play out in a positive way. Other than I will say that Zach has been a force to reckon with on Twitter, and he has exposed a lot of garbage, and he's gotten a lot of support for doing so. So I'm glad about that, but I will say that he himself knows that, like, he can't stop them from just creating a pseudonym and jumping right back in and starting some new scam project. I also think that, like, the popularity of cryptocurrency and all of this money flowing in, this what did you call it, a hot pile of cash, that drives bad actors to want to pursue that money as well. I mean, North Korea hacking the Ronin network, they did that because there was so much to be had, and this is the best and easiest way for them to evade sanctions now, for them to acquire illicit funds. Like, it's easier than trying to rob banks, which is what they were doing before. Like, in 2016 or 2014, they were robbing the Bangladeshi central bank, right? But now they're finding it easier to rob a bunch of cryptocurrency proponents and projects than to try to rob the Fed repeatedly.
Yeah, but I think that fits fundamentally with this idea that crypto is just like, it's basically speedrunning the history of finance. So I think, even that in a bizarre way should give you some sort of optimism, where in the sense that, yes, so we're basically at the point where maybe we're at the Wild West where people actually could rob banks still. I don't think most people actually physically rob banks anymore. Most of their cash is not even stored on site. But yeah, I mean, it's really, this is going to be the do or die moment where crypto needs to decide, is it going to be a speculative casino forever? Or are we going to shape up and start protecting consumers? Are we going to comply with regulations? And are we going to take risks seriously?
Perfect. Great. Thank you, Lily. That was awesome.
Yes, thank you.